Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey Prime investors, Martin Maxwell here, and welcome to episode 81 of the 5-Minute Prime Podcast. We just wrapped up our massive 4-part series on mastering the mortgage. We started by deconstructing your personal loan payment in episode 77, zoomed out to the global bond markets in 78, built your power borrower playbook in 79, and finally, in episode 80, we connected all the dots to understand how that mortgage shockwave is remaking the entire housing market. If you haven't listened to that series, I highly recommend you do. It's the foundation for what comes next. Because today, we're shifting gears. We're talking about refinancing, but not in the way most people think about it. For a typical homeowner, a refinance is a defensive move, a way to save a few $100 on their monthly bill. For a strategic real estate investor, refinancing is an offensive weapon. The goal isn't the lower payment. The goal is the bigger paycheck. It's about taking the lazy, trapped equity sleeping inside your properties and putting it back to work to generate new income. Today, we'll deconstruct the why behind an investor refinance and then dive deep into the two primary tools you have at your disposal, the cash-out refinance and the home equity line of credit, or HELOC. This is where you turn a single successful property into the launch pad for your entire portfolio. Let's get into it. For a typical homeowner, the goal of a refinance is simple: lower the monthly payment. It's a valid goal, but it's a small one. For an investor, that's just the beginning. Our primary goal is something different. It's capital velocity. We don't want our money sitting dormant inside a property's equity, slowly building value over 30 years. We want that capital moving, acquiring new assets, and generating new streams of income. That equity is a powerful tool, but only if you use it. Think of your portfolio as a toolkit. Refinancing is the power tool that unlocks its full potential. You're not just managing a bill, you're actively managing your capital to perform specific strategic jobs. The first and most powerful job is unlocking equity for portfolio expansion. This is the big one. Imagine you bought a duplex 2 years ago, and through a combination of paying down the mortgage and market appreciation, you now have $100,000 in equity. A refinance can pull that cash out, giving you the down payment for your next acquisition, maybe a 4-plex this time. This is how you scale from 1 property to 5 or 5 to 20 without having to constantly save up new capital from your 9-to-5 job. You're using the success of your past investments to fuel your future ones. The second job is financing value-add renovations. Let's say you own a property with untapped potential. The kitchens are dated, the curb appeal is lacking. You can pull out $50,000 in a refinance to execute a strategic renovation. Those upgrades allow you to increase the rents by, say, $400 per month, which boosts your cash flow and forces the property's appreciation. The refinance literally pays for the renovation that in turn makes the property more valuable and profitable. Third, you can use it to enhance cash flow on an existing asset. A simple rate and term refinance, where you just get a new loan at a better rate, can lower your monthly mortgage payment. That directly increases your net operating income, or NOI. It's a straightforward way to make an existing asset more profitable from day one, freeing up cash for reserves or other opportunities. And fourth, it's a critical tool for consolidating high-interest debt. Many investors, especially those using the BRRRR method we'll talk about next week, use short-term, expensive financing like hard money or private loans to acquire and rehab a property quickly. A traditional refinance allows you to pay off that 12% interest hard money loan and replace it with stable long-term financing at a much lower rate, dramatically improving the property's cash flow. The mindset shift here is absolutely crucial. You are moving from being a passive bill payer to an active capital manager. Okay, so you've made the strategic decision to access your equity. You have 2 primary tools to do it, and choosing the right one for the job is critical. Let's put them head to head. First, you have the workhorse, the cash-out refinance. This is a brand new, larger first mortgage that completely replaces your old one. You borrow more than you currently owe, and the lender gives you the difference in a tax-free lump sum at closing. Its key feature is that it typically comes with a fixed interest rate, giving you long-term payment stability and predictability. For an investor, a cash-out refinance is perfect for large one-time expenses where you know the exact cost. Think of a $100,000 down payment for your next apartment building or a $50,000 renovation project with a fixed contractor bid. Lenders have hard rules here. For a cash out on an investment property, Freddie Mac guidelines and most banks will cap your loan to value, or LTV, at 75%. That means on a $400,000 property, your maximum new loan is $300,000. If you owe $180,000, you can pull out $120,000 in cash. On the other side, you have the flexible specialist, the home equity line of credit, or HELOC. This is a second mortgage that sits behind your existing one and acts like a revolving line of credit secured by your property. It's like a credit card for your equity. You typically have a draw period of 5 to 10 years where you can pull funds as you need them, pay them back, and draw them again up to your limit. After that, it converts to a repayment period where you pay back the principal and interest. The key feature here is that HELOCs almost always have a variable interest rate, often tied to the prime rate, which means your payment can change over time as market rates fluctuate. For an investor, a HELOC is ideal for situations with uncertain costs or timing. Think of ongoing rehab projects, having a ready source of dry powder for opportunistic deals, or establishing a large liquid emergency fund for your entire portfolio. So you have the stable workhorse and the flexible specialist. But how do you choose? Well, in today's market, one factor often makes the decision for you. This brings us directly back to the mortgage rate lock-in effect we dissected in episode 80. Recent data from entities like the Federal Housing Finance Agency shows that a staggering number of mortgage holders, some estimates say over 80%, have an interest rate below 5%. They are in what we call golden handcuffs. A cash-out refinance forces you to give up that entire existing mortgage. If you're one of the lucky investors sitting on a rock-bottom 3% rate from 2021, a cash-out refi means you have to replace that entire loan with a new one at today's higher rates. It can be a very expensive trade-off just to access your equity. A HELOC, however, leaves your amazing first mortgage completely untouched. It sits quietly in second position, giving you access to that valuable equity without disrupting your low-rate primary loan. In a high-rate environment, the HELOC has become an investor's best friend. The choice isn't just about how you get the money, it's about the profound impact on your existing financing structure. So the big takeaway today is that for an investor, refinancing is a strategic weapon, not just a homeowner's errand. The choice between a lump sum, fixed-rate cash-out refi and a flexible variable rate HELOC depends entirely on your mission. One gives you stability for a known cost, the other gives you flexibility for unknown opportunities, and critically can protect a fantastic existing loan. Now, your challenge today. Take one of your investment properties and do a quick back-of-the-napkin calculation. Go online and get an estimate of its current market value. Multiply that value by 75%, which is a typical lender's maximum loan-to-value, or LTV. Then subtract what you currently owe on the mortgage. That number is your potential available equity. Now ask yourself one question. What is the highest and best use for that trapped capital right now? Just thinking about it will shift your perspective from passive owner to active investor. Now that you know the what and why, next week we're getting into the how-to. We'll cover the gauntlet of getting approved for an investor loan, the costly analytical mistakes to avoid, and the advanced burst strategy that can supercharge your growth.